Hello, and welcome to today's webinar, Determining an Individual's Tax Residency Status. I see it's the top of the hour. We're glad you joined us today. My name is Anika Pompey, and I'm a Senior Stakeholder Liaison with the Internal Revenue Service. I will be your moderator for today's webinar, which is slated for approximately 120 minutes. This webinar offers 2 IRS continuing education credits. Participants earn 2 IRS continuing education credits and a related certificate of completion by attending the live broadcast of the webinar for at least 100 minutes after the official top of the hour start time, and by answering at least 4 polling questions during the live broadcast. The polling question example to test your pop-up blocker will count as an attendance check towards the polling question response requirement. So before we begin, if there is anyone in the audience that is with the media, please send an email to the address on the slide. Be sure to include your contact information and the news publication you're with. Our media relations and stakeholder liaison staff will assist you and answer any questions you may have. And as a reminder, this webinar will be recorded for future posting. Please note, continuing education credit or certificates of completion are not offered if you view any version of our webinar after the live broadcast. Now, we hope that you won't experience any technology issues, but if you do, this slide shows helpful tips and reminders. We've posted a technical help document that you can download from the material section on the left side of your screen. It provides the minimum system requirements for viewing this webinar, along with some best practices and quick solutions. If you completed and passed your system check and you are still having problems, try one of the following. First, close the screen where you're viewing the webinar and relaunch it. Or you can click on the settings on your browser viewing screen and select HLS. Now, you should have received today's PowerPoint in a reminder email, but if not, no worries. You can download it by clicking the materials drop-down arrow on the left side of your screen, as shown on this slide. To receive our survey at the end of the presentation, you need to have your pop-up blocker disabled. We've also included several technical documents that describe how you can allow pop-up blockers based on the browser you're using on the Materials tab. Closed captioning is available for today's presentation. If you are having trouble hearing the audio through your computer speakers, please click the closed captioning drop-down arrow located on the left side of your screen. This feature will be available throughout the webinar. Now, if you have a topic-specific question today, please submit it by clicking the Ask Question drop-down arrow to reveal the text box. Type your question in the text box and click Send. This is very important. Please do not enter any sensitive or taxpayer-specific information. Now, during the presentation, we're going to take a few breaks to check in and engage with you. At those times, a polling style feature will pop up on your screen with a question and multiple choice answers. Select the response you believe is correct by clicking on the radio button next to your selection and then click Submit. If you do not get the polling question, this may be because you have your pop-up blocker on. So please take a moment to disable your pop-up blockers now so you can answer the questions. We've included several technical documents that describe how you can disable pop-up blockers based on the browser that you're using. So we have documents for Chrome, Firefox, Microsoft Edge, and Safari for Macs. You can access them by clicking on the Materials drop-down arrow on the left side of your screen. Now, we are going to take some time and test the polling feature. So here's your opportunity to ensure your pop-up blocker is not on so you can receive the remaining polling questions throughout today's presentation. Audience, this example polling question will count towards the polling question requirement to earn CE credit. So here's your question. Do you know who your local stakeholder liaison is? Answer A for yes, B for no, C, what is a stakeholder liaison? Take a moment and click the radio button that corresponds to your answer. I'll read that again. Do you know who your local stakeholder liaison is? Answer A for yes, B for no, or C, what is a stakeholder liaison? I'm going to give you a few more seconds to make your selection. Okay, so we're going to stop the polling now. Let's see how the majority of you responded. All right, I see that 50% of you chose letter B, which was no. So for those of you who selected B or C, I encourage you to visit irs.gov and enter stakeholder liaison in the search bar. You should see a link for stakeholder liaison local contacts that should take you to our page to learn more about our role as collaborative outreach champions and how to reach your local stakeholder liaison. Now, we hope that you received the polling questions and were able to submit your answers. If not, now is the time to check on your pop-up blocker. You want to make sure that you have it turned off. Again, we've included several technical documents that describe how you can disable pop-up blockers based on the browser that you're using. So just click on the materials drop-down arrow on the left side of your screen, and you can download your browser document. Again, I want to welcome you all, but before we move along with our session, let's just make sure you all are in the right place. Today's webinar is Determining an Individual's Tax Residency Status. This webinar is scheduled for approximately 120 minutes from the top of the hour. Now, let me introduce our esteemed panel of speakers. Today we are joined by Senior Revenue Agents Bethany Krause, Emma Sadikovic, and Kathy Bissett with the Large Business and International Division. They are all technical specialists for the individual compliance jurisdiction to tax practice network. And they are responsible for facilitating and coordinating the identification and development of issues on examinations involving U.S. tax residency status and the taxation of U.S. individuals living and or working outside of the United States. Now, Bethany previously worked in numerous examinations as a revenue agent in LB&I, IIC. Bethany has expertise in a variety of topics, including residency status, the foreign earned income exclusion, taxation of individuals with income from U.S. territories, and employees of foreign governments and international organizations. She's developed and presented numerous training courses and workshops, presenting them within the IRS. Bethany has also developed and presented courses on behalf of the IRS to external audiences. Bethany holds a Bachelor of Science in Computer Science with a minor in accounting and courses in education. So next we have Emma. So Emma has expertise in a variety of topics, including foreign earned income exclusion, expatriation, and taxation of individuals with income from U.S. territories. Emma is a certified public accountant, and she currently has active status, and she holds a Bachelor of Business Administration with emphasis in accounting and finance, and also a Master of Accounting and a Juris Doctor. Lastly, but certainly not least, we have Kathy. Kathy has been with the IRS for 15 years. She previously worked in numerous examinations as a revenue agent in the Small Business and Self-Employed Division, including international cases. Kathy has expertise in a variety of topics, including residency status, the foreign earned income exclusion, taxation on individuals with income from U.S. territories, as well as employees of foreign governments and international organizations. Kathy holds a Bachelor of Science in Accounting with a minor in computer technology, as well as a Master in Accounting and Taxation. So let us all give a virtual welcome to Bethany, Emma, and Kathy. And I am going to turn it over to Emma to kick off the presentation. Emma, the floor is yours.
Thank you, Anika. Our topic today is determining an individual's tax residency status. During today's webinar, we will explain the impact of residency status on U.S. taxation. We'll discuss the differences between residency status under U.S. immigration law and residency status under U.S. tax law. We will talk about how an individual's residency status is determined for U.S. tax purposes, and we will go over the special tax rules that apply to dual status individuals. Residency concepts under U.S. tax law and U.S. immigration law overlap but are not synonymous. Under U.S. immigration law, individuals are classified as U.S. citizens or nationals, immigrants, meaning lawful permanent residents, non-immigrants, and undocumented individuals. United States Citizenship and Immigration Services, which we will also refer to as USCIS throughout today's webinar, is the federal agency that oversees lawful immigration to the United States. The Internal Revenue Service administers and enforces U.S. federal tax laws. Under U.S. tax law, individuals are classified as U.S. citizens or residents, non-residents, and dual status individuals, meaning those who are both a U.S. resident and a non-resident during the same tax year. We have a lot of information to share today and want to make sure that we also have some time available to answer some of your questions at the end of this presentation. So let's get started. We're talking about this topic today because your residency status for U.S. tax purposes is very important in that it affects how you're taxed. Your tax residency status determines your filing status, the amount of your income that is subject to U.S. income tax, which deductions, credits, and exemptions you're able to claim, and the applicable tax rates. The U.S. generally taxes its citizens and residents on worldwide income. They may also be subject to employment taxes. U.S. citizens and residents, which we will define more clearly in a moment, generally file a Form 1040. Non-residents are taxed only on U.S. source investment income and income that is effectively connected with the conduct of a U.S. trade or business. They generally file Form 1040-NR. Let's start by talking briefly about U.S. citizens. Under U.S. immigration law, an individual may become a U.S. citizen at birth if born in the United States or certain territories: the Commonwealth of the Northern Mariana Islands, Guam, Puerto Rico, and the U.S. Virgin Islands. Persons born in American Samoa are generally considered nationals, but not citizens of the United States. A U.S. national is an individual who owes their allegiance to the United States. The term includes all U.S. citizens, individuals who were born in American Samoa, as well as those born in the Commonwealth of the Northern Mariana Islands before November 4, 1986, who have made the election to be treated as U.S. nationals and not as U.S. citizens. An individual may also become a U.S. citizen at birth if born abroad to a U.S. citizen parent. An individual whose parent is a U.S. citizen and who did not establish U.S. citizenship at birth may acquire U.S. citizenship by obtaining a certificate of citizenship. A certificate of citizenship may be requested by filing Form N-600 or Form N-600K with USCIS. Naturalization is what we call the process by which a foreign individual applies for U.S. citizenship. If the person is eligible and fulfills the requirements established by Congress, they will be granted citizenship. The document that shows a person has been naturalized is called a Certificate of Naturalization. U.S. law allows for dual nationality and does not require a person to choose one nationality or another. A U.S. citizen may naturalize in a foreign state without any risk to their U.S. citizenship. A dual citizen is generally taxed in the same way as any other U.S. citizen on worldwide income. Now, Kathy will talk about how those individuals who are not U.S. citizens are categorized. Kathy?
Thanks, Emma. So as Emma mentioned earlier, U.S. immigration law and U.S. tax law have concepts that overlap, but they're not synonymous. Under U.S. immigration law, an individual who is neither a U.S. citizen nor a U.S. national is classified as either an immigrant, a non-immigrant, or undocumented individual. So these categories are related to, but not the same as the categories under U.S. tax law for tax residency purposes. An individual that is classified as an immigrant is one who is granted the right to permanently reside in the United States and is commonly referred to as a lawful permanent resident, or LPR. And this is also known as a green card holder. So a non-immigrant under immigration law is someone who has been granted the right to temporarily stay in the United States, usually on a visa. And an undocumented individual is someone who has either overstayed their visa or who entered the United States without authorization. So the three categories of residency status for U.S. income tax purposes are resident, non-resident, and dual status. An individual who is an immigrant, in other words, a lawful permanent resident or green card holder under U.S. immigration law, is a U.S. resident under U.S. tax law. An individual who is either a non-immigrant or an undocumented individual under U.S. immigration law could, depending on the circumstances, be a U.S. resident, a non-resident, or a dual status individual under U.S. tax law. For example, someone could be an undocumented individual under U.S. immigration law, but be a U.S. resident for tax purposes under U.S. tax law. So first let's talk about those who are residents of the United States under U.S. tax law. A lawful permanent resident is a resident of the United States for U.S. tax purposes. This is generally true even if they are not physically present in the United States during the tax year. The lawful permanent resident or green card test is one of the two tests under which a person who is not a U.S. citizen can be determined to be a U.S. resident for U.S. income tax purposes. The other is the substantial presence test, which we will discuss in more detail shortly. In addition, a person can also make a first-year election under Internal Revenue Code Section 7701B4 to be treated as a U.S. resident for that tax year if they meet the qualifications. So please be aware that exceptions may apply if an individual who meets the substantial presence test has a closer connection to a foreign country than to the United States. Such an individual may be able to be treated as a non-resident for U.S. income tax purposes under the closer connection exception, which we will discuss later. In addition, if an individual who is either a green card holder or meets the substantial presence test is also considered to be a resident of a foreign country with which the United States has an income tax treaty, that individual may be eligible to be treated as a non-resident for U.S. income tax purposes. Such an individual may choose to be treated as a non-resident, but only for purposes of computing their U.S. income tax liability. So now that we've defined a resident, it's easy to define a non-resident. And a non-resident is an individual who is not a U.S. citizen, is not a lawful permanent resident, aka green card holder, or did not meet the substantial presence test, and did not make a first-year election under IRC Section 7701B4. Now for the third category listed here, a dual status individual is one who is both a non-resident and a resident for U.S. tax purposes in the same tax year. So now that we've defined the various categories of non-U.S. citizens or nationals for U.S. income tax purposes, let's talk about the impact each category has on taxation. So as mentioned earlier, residents are taxed on worldwide income. This means that they must report and pay applicable federal income taxes on all of their income, regardless of the source, unless it is specifically exempt under the Internal Revenue Code or a tax treaty provision. They generally file a Form 1040. So the taxing provisions for non-residents are found in Code Section 871. Non-residents are taxed on U.S. source investment income and on income that is effectively connected with the conduct of a U.S. trade or business. Taxation of non-residents will be covered in more detail later in this webinar. A non-resident that is married to a U.S. citizen or resident may elect to be taxed as a U.S. resident and file a joint return with their spouse under IRC Section 6013 G or H. And we'll talk more about that later in this presentation. But before we move on, let's pause here for a polling question. Anika?
Sure thing, Kathy. It's a great time for the first polling question. So, audience, I want you all to take a moment and click the radio button that best answers the question. When deciding which form to file, Form 1040 or 1040 NR, the determining factor is A, the source of income, domestic or foreign, B, the mailing address, domestic or foreign, C, residency status for U.S. income tax purposes, or D, none of the above. Now, if you did not receive the polling question, please enter only the letters A, B, C, or D that corresponds with your answer in the Ask Question text box. Your response is time-stamped. And please remember that you do need to answer at least 4 polling questions and participate in the live broadcast from the official start for at least 100 minutes to earn 2 IRS continuing education credits. Now, the polling question example we did at the beginning of this presentation will count towards the requirement. I'm going to give you a few more seconds to make your selection or submit your answer in the Ask Question feature. Okay, so we're going to go ahead and stop the polling now, and let's share the correct answer on the next slide. And the correct response is C, residency status for U.S. income tax purposes. And I see that 90% of you responded correctly, so that is a great response rate. Okay, Kathy, I'm going to turn it back to you.
Thanks. So I mentioned earlier, an individual who is both a non-resident and a resident in the same tax year is referred to as a dual status individual. And dual status does not refer to citizenship, only to residency status for U.S. tax purposes. And dual status usually occurs in the year of arrival into the United States or departure from the United States. Okay, now that we've defined the various categories of residency status for U.S. income tax purposes and the impact of that residency status on taxation, let's talk about how residency status is determined. And Bethany will explain how to approach that. Bethany?
Okay, thank you. Thank you, Kathy. Okay, let's look at some rules about tax residency. If you are not a U.S. citizen or national, then the starting point when you're thinking about residency for U.S. tax purposes is you first want to look at the Internal Revenue Code. And the pertinent section is 7701B. And that defines the term resident and non-resident. You also may want to look at the regulations associated with that code section. Now, if you are a resident of a country with which the United States has an income tax treaty, then you might next want to consider the residence or residency article in the applicable income tax treaty. Sometimes an individual who is a U.S. resident under the Internal Revenue Code may also be treated as a resident of a foreign country with which the United States has a income tax treaty under that country's domestic law. And if that's the case, an individual like that, we refer to them as a dual resident. And that's not to be confused with dual status individuals that Kathy talked about a minute ago. Now, please be aware that except for very limited circumstances, a person has to be a resident of one of the two contracting states, meaning the two countries that are party to the income tax treaty, in order to claim a benefit under that treaty. In other words, in order to claim that that income tax treaty reduces or eliminates tax that would otherwise be due under a country's domestic law. In our case, when we say domestic law, we mean the Internal Revenue Code from a U.S. perspective. Now, whether you're a resident of a country for treaty purposes is going to be key to knowing if you're eligible to claim treaty benefits. Income tax treaties typically have what are known as tiebreaker rules. And those are the rules that determine residence for purposes of the treaty of an individual. And these are found, typically they're going to be found in Article 4. That's where they're found in most treaties, but every treaty is unique, so they could be elsewhere. A U.S. resident who's claiming residency in a foreign country under the tiebreaker rules of a treaty must timely file a Form 1040-NR with an attached Form 8833, treaty-based return position disclosure. Every treaty is different. I can't emphasize that enough. Each one is unique. I don't think any two are absolutely identical. So if your client wants to claim that they're a non-resident of the United States for U.S. tax purposes under the terms of an income tax treaty, you're going to want to carefully review the residence or residency article and any other applicable articles in the treaty to determine whether your client meets the treaty definition of a resident. You also might want to look at the Treasury Department's technical explanation to the treaty in question, as well as any other relevant documents. Those technical explanations can be found at irs.gov's webpage titled Treaties A to Z. And now we're going to talk about residency start dates. So I'm going to turn this over to Emma. Emma?
Thank you, Bethany. If you have a green card, then you're a U.S. resident for tax purposes. Your residency start date is generally your first day of physical presence in the United States as a lawful permanent resident. However, if you also met the substantial presence test, which we will discuss in a few minutes, your residency start date is the earlier of your first day of physical presence in the United States under either test. If you're a lawful permanent resident, you're subject to U.S. taxation on your worldwide income, whether you're living in the United States or abroad. The U.S. income tax responsibilities of a green card holder do not change even if you're absent from the United States. Signing up the green card or remaining outside the United States for an extended period of time does not change your status from resident to non-resident for tax purposes. And how about our next polling question? Anika?
Okay, Emma, perfect time for a polling question. So, audience, this next question is, well, true or false? A lawful permanent resident who leaves the United States and shreds their green card is still subject to U.S. taxation. Select A for true or B for false. So take a moment and click the radio button that best answers the question. If you do not receive the following question, please enter only the letter A or B that corresponds with your response in the Ask Question text box. Your response is timestamped. I'm going to give you a few more seconds to make your selection or submit your answer in the Ask Question feature. Okay, so we are going to stop the polling now, and let's share the correct answer on the next slide. And the correct response is A, true. I see that 95% of you responded correctly. You guys are doing a great job. Emma, it looks like you're continuing our discussion on the lawful permanent resident status. I'll turn it over to you.
That's correct. A green card holder's U.S. tax status continues until their lawful permanent resident status is determined to have been rescinded or abandoned under U.S. immigration law. Even if a green card holder lives outside the United States, they remain a U.S. resident for tax purposes until they voluntarily turn their green card and renounce their U.S. immigrant status by signing USCIS Form I-407, or they undertake other acts that result in the rescission of their LPR status. Abandonment occurs when either the green card holder voluntarily gives up their LPR status by filing USCIS Form I-407, or USCIS administratively or a court judicially determines the green card holder has voluntarily abandoned their LPR status. If an individual is neither a U.S. citizen nor a lawful permanent resident, then the first consideration is whether they met the substantial presence test. The substantial presence test involves counting days on which an individual is actually physically present in the United States, generally starting with the day they first arrived in the United States. Note that the term United States here does not include U.S. territories or U.S. airspace. Certain days of presence in the United States may not count for the purpose of this test. Under the substantial presence test, an individual is considered a U.S. resident for tax purposes if they're physically present in the United States at any time during the day on at least 31 days during the tax year and 183 days during the 3-year period that includes the tax year in question and the 2 years immediately before that, counting all days present in the United States in the tax year and 1/3 of days present in the United States in the first year before the tax year and 1/6 of days present in the United States in the year before that. For example, you are physically present in the United States on 150 days in each of the years, 2022, 2023, and 2024. To determine if you meet the substantial presence test for 2024, count the full 150 days of presence in 2024, 50 days in 2023, which is 1/3 of 150, and 25 days in 2022, which is 1/6 of 150. Because the total for the 3-year period is 225 days, you meet the substantial presence test and are a U.S. resident for tax purposes for 2024. Certain individuals are exempt from counting U.S. days of presence for purposes of the substantial presence test. Kathy will talk about these exempt individuals next.
Okay, so the days as an exempt individual do not count for purposes of the substantial presence test. In the term exempt individual, does not mean exempt from U.S. tax. It just means exempt from counting days present in the United States. And this will include an individual temporarily present in the United States as a foreign government-related individual who is under an A or G visa, other than individuals holding A3 or G5 class visas. Individuals present in the United States under an A3 or G5 visa as a personal employee, attendant, or domestic worker for either a foreign government or international organization official, they are not considered a foreign government-related individual, and they must count all days of presence in the United States for purposes of the substantial presence test. So who is a foreign government-related individual? They are exempt from counting days of presence for purposes of the substantial presence test. And these are individuals on an A or G visa or a member of the individual's immediate family who is temporarily present in the United States. They are a full-time employee of an international organization by reason of diplomatic status or by reason of a visa other than a visa that grants lawful permanent residence that the Secretary of the Treasury determines represents full-time diplomatic or consular status. An individual is considered to have full-time diplomatic or consular status if they have been accredited by a foreign government that is recognized by the United States. They intend to engage primarily in official activities for that foreign government while in the United States, and they have been recognized by the President, Secretary of State, or a consular officer as being entitled to that status. So members of the immediate family include the individual's spouse and unmarried children, but only if the spouse's or unmarried children's visa statuses are derived from and dependent on the exempt individual's visa classification. Unmarried children are included only if they are under 21 years of age, they reside regularly in the exempt individual's household, and they are not a member of another household. And other exempt individuals include a teacher or a trainee temporarily present in the United States under a G or Q visa who substantially complies with the requirements of the visa. Also included are immediate family members of exempt teachers and trainees. So an individual generally will not be considered an exempt individual if they were exempt as a teacher, trainee, or student for any part of 2 of the 6 preceding calendar years. However, there is an exception if they were exempt as a teacher, trainee, or student for any part of 3 or fewer of the 6 preceding calendar years, and all of their compensation was and is paid by a foreign employer. So please see publication 519 for more information on this, and that's the tax guide for aliens. So another type of exempt individual is a student who is temporarily present in the United States under an F, J, M, or Q visa who substantially complies with the requirements of the visa. Also included are immediate family members of exempt students. So an individual will not be exempt as a student if they have been exempt as a teacher, trainee, or student for any part of more than 5 calendar years, unless they not only meet the criteria shown here, but are also able to establish that they do not intend to reside permanently in the United States, meaning the facts and circumstances bear this out in that they have maintained a closer connection to a foreign country and have not taken steps toward lawful permanent resident status. Also, an exempt individual is a professional athlete who is temporarily in the United States to compete in a charitable sports event. A charitable sports event is one for which the main purpose is to benefit a qualified charitable organization. The entire net proceeds go to charity, and volunteers do most of the work. So in figuring days of presence, exclude only the days when they actually competed in the sports event. So other days that do not count for purposes of the substantial presence test are days where an individual was unable to leave the U.S. because of a medical condition that developed while in the United States, or they were in the U.S. less than 24 hours in transit between two places outside the United States. However, please note that a person is not considered in transit if they attended a business meeting while in the United States, even if that business meeting was held at the airport. So other days that do not count are days an individual commuted to work in the United States from a residence in Canada or Mexico if they regularly did so, or days when they were in the United States as a crew member of a foreign vessel engaged in transportation between the United States and a foreign country or U.S. territory, unless the person otherwise engaged in a trade or business in the United States on those days. If an individual excludes days of presence in the United States because they were temporarily in the United States as a teacher or trainee on a J or Q visa, or they were temporarily in the United States as a student on an F, J, M, or Q visa, or were a professional athlete competing in a charitable sports event, or they were unable to leave the United States due to a medical condition that arose while they were here, so then the individual must file Form 8843, Statement for Exempt Individuals and Individuals with a Medical Condition, and it must be attached to the income tax return. Or, if they're not required to file an income tax return, Form 8843 must be filed as a standalone form by the due date for filing the Form 1040-NR or Form 1040-EZ. Emma will now discuss the de minimis rule and its effect on an individual's residency starting date. Emma?
Thank you, Kathy. As mentioned earlier, an individual's residency starts under the substantial presence test is generally their first day present in the United States. However, under what is known as the de minimis rule, an individual may be in the United States for up to 10 days without triggering the residency start date or extending the residency termination date. If the individual is able to establish that during that period, their tax home was in a foreign country and they maintained a closer connection to that foreign country than to the United States. So what do we mean by closer connection? This means that the taxpayer has stronger ties and has maintained more significant contacts with that foreign country than with the United States. Any days excluded under this de minimis rule still count for purposes of determining total days of presence. So even though those days may be disregarded in terms of determining residency start date, they're still counted for purposes of determining whether the substantial presence test was met. An individual who wishes to exclude days under this rule must file a statement with the IRS. For more information on this, refer to page 9 of publication 519, Tax Guide for Aliens. There are a few important points about the de minimis rule. In order to disregard dates for purposes of determining the residency starting date under this rule, an individual must be able to establish that on those days they had a closer connection to a foreign country and had a tax home in that foreign country. Can disregard days for more than one period as long as the total days in all periods is not more than 10. One other important point about the de minimis rule is that an individual cannot disregard any days in a period of consecutive days of presence unless all days in that period can be excluded. Please note that disregarded days still count as days of presence for purposes of determining whether the substantial presence test is satisfied. We've talked about how when residency begins. What about an individual's residency ending date under the substantial presence test? Kathy?
Thanks, Emma. Yes, let's talk about the residency ending date under the substantial presence test. So generally, it's the last day of the calendar year in which the individual left the United States. However, if after leaving the United States, they can show that for the rest of the year, their tax home was in a foreign country and they maintained a closer connection to that foreign country than to the United States, the residency ending date is the last day present in the United States. So for an individual who satisfies the substantial presence test for the year and also was a lawful permanent resident, it's the later of the residency ending date under the substantial presence test or the first day the individual is no longer a lawful permanent resident. Now, Bethany will discuss the closer connection exception to the substantial presence test. Bethany?
Okay, thank you, Kathy. Now, under the closer connection exception, even if an individual meets the substantial presence test, as you know, we're looking at 3 years, right? As Kathy just explained. It's a spanning a 3-year period. So if a person meets that test, they could still be treated as a non-resident of the United States if during the year that you're looking at, meaning the year you're filing the return for, all of the following are true. The individual was present in the United States for less than 183 days in that year, and they maintained a tax home in a foreign country during the entire year, and they had a closer connection during the year to that foreign country where they have the tax home than to the United States, and they had not taken any steps toward and did not have any application pending for lawful permanent resident status, meaning a green card. Now, what do we mean by closer connection? Well, there are a number of factors that need to be considered in determining whether someone has a closer connection to a foreign country than they do to the United States. And some of those are listed here. Does this person have a permanent home? And if so, where is that located? Where does their family live? What about vehicles or other items that they own? Where do they keep those? What organizations are they involved in? And where are those located? Other factors to consider in determining whether someone has a closer connection to a foreign country than they do to the United States include things like where they bank, where they may have a driver's license, where do they vote? Are they registered to vote in this country, that country, or both? Where do they conduct business activities other than those that take place in their tax home? Now, when we say tax home here, and also earlier, a couple slides ago, you heard me say tax home, we mean primary place of business. Okay? An individual who meets all the requirements, meaning they were in the United States less than 183 days during the year, their tax home was in a foreign country during the entire year, they had a closer connection to that country than they did to the United States, and they had not taken any steps toward becoming a lawful permanent resident, meaning obtaining a green card. If all of that is true and they are claiming a closer connection to a foreign country, they must file Form 8840. The name of that form is Closer Connection Exception Statement for Aliens. And that needs to be filed on or before the due date for filing an income tax return, including any extension. Okay? This is true even if they are not required to file a U.S. income tax return, in which case they would need to file it as a standalone form. Well, this seems like a good time for another polling question. Anika, what do you think?
I agree. So, audience, it looks like we have another true or false question. The question states, you must file Form 8840 Closer Connection Exception Statements for Aliens as a standalone form if you are claiming the Closer Connection Exception and are not required to file a U.S. federal income tax return. Answer A, if you believe it's true. Answer B for false. Just take a moment and click the radio button that best answers the question. If you do not receive the polling question, please enter only the letter A or B that corresponds with your response in the Ask Question text box. Your response is going to be time-stamped. Now, I'll give you a few more seconds to make your selection or submit your answer in the Ask Question feature. All right, we are going to stop the polling now and let's share the correct answer on the next slide. And the correct response is A, true. Okay, I see that 87% of you responded correctly. This is very impressive, audience. It's clear that you all are paying attention and really taking the information in. So, Emma, I'm going to turn it over to you to discuss the first-year election.
Thank you, Anika. Now let's talk about the first-year election. An individual who arrives in the United States after the midpoint of the year and does not qualify as a U.S. resident under either the green card test or the substantial presence test might qualify as a U.S. resident for part of the calendar year of their arrival by making the first-year election under Section 7701B4. In order to make the first-year election, that individual must meet all 5 of the following requirements: not have been a U.S. resident under either the green card test or the substantial presence test during the year in question, also referred to as the current year or the election year, and not have been a U.S. resident under either test in the calendar year immediately preceding the election year. And they also must satisfy the substantial presence test for the calendar year immediately following the election year and have been present in the United States for at least 31 consecutive days during the election year and have been present in the United States for at least 75% of the days beginning with the first day of the 31-day period and ending with the last day of the election year. So if a person who did not have a green card and did not meet the substantial presence test for the year arrived in the United States on September 3rd of 2024, stayed in the United States for 31 consecutive days, then was in the United States for at least 75% of the days from September 3rd through the end of the year and later met the substantial presence test in 2025, that person would be eligible to make a first-year election to be treated as a dual status individual for 2025. meaning they would be treated as a non-resident before arriving in the United States and as a U.S. resident for the last part of the year. Again, an individual electing to be treated as a dual status, in other words, electing to be treated as a U.S. resident for the latter part of the year, must wait until they have met the substantial presence test in the following year. For this reason, they would need to file an extension and then submit the return later in the year, once the substantial presence test is met, including a statement that they're making an election under Section 7701B4. They must still pay tax computed as a non-resident by the original due date of the return. Next, Kathy will explain what is known as the no lapse rule.
All right, so this rule applies to an individual who is a U.S. resident during any part of 2 tax years in a row. So this usually applies to situations where an individual terminates their residency in 1 year, but then comes back and becomes a U.S. resident again in the next year. So under the no lapse rule, an individual who was a U.S. resident during any part of the preceding calendar year and was a U.S. resident for any part of the current year, they will continue to be taxed as a U.S. resident at the beginning of the current year. So similarly, an individual who was a U.S. resident for any part of the current year and was also a U.S. resident for any part of the following year, they will be taxed as a U.S. resident through the end of the current year, even if they have a closer connection to a foreign country than to the United States during the current year. So let's change gears a bit and talk about the effect of an income tax treaty on an individual's residency status. Bethany?
Okay. Now, some of you might be wondering, and I think I already saw a question or two about that, about the dual resident taxpayer, meaning an individual who is a tax resident of both the United States and of a foreign country under each country's domestic law. And as I mentioned earlier, we refer to such an individual as a dual resident. If there is a treaty between the United States and the foreign country, it could offer relief from double taxation because the resident or residence article of those treaties, as I mentioned earlier, typically have tiebreaker rules that determine residence for purposes of the treaty of such individuals. Now, generally, the residence or residency article of the United States income tax treaties consider these factors that you see here on the slide in the order that they're listed here when determining a single country of residence under the treaty. The first one is a permanent home. Where does the individual have a permanent home? Now, a permanent home does not need to be a house that someone bought or purchased. It could be a room that they are renting. It could be just a rental situation. The key is that it's a place that they can keep coming back to again and again. So where do they have a permanent home? If they have a permanent home in both countries, then the next step is to consider the location of what is referred to often as the center of vital interest. That would mean the place where their ties are the strongest. If their center of vital interest happens to be in both countries, then the next step would be to consider the location of their habitual abode, meaning where do they spend the most time. It would be very unusual for that to come out even, where it's exactly the same in each country. That would be highly unusual. Again, these different tiebreaker rules are taken in the order that they appear here. So if I have a permanent home in country A and not in country B, then we're already done. Under the treaty, I'm a resident of country A. If it happens that I have a permanent home in both countries, that's when we move to the center of vital interest. And if we can determine which country I have a stronger tie to, then again, that's where we stop. And then I would shake out as a resident of that country. If, however, that seems to be fairly even, then the next step would be habitual abode. And again, it would be very unusual for that to be a tie. But if it were, then the next step would be to consider nationality. Of which country is the person a citizen? And then, if for some reason none of those, we got to the end of that, none of that resolves the issue, then the residence articles of most income tax treaties provide that the competent authorities of the two countries that are party to the treaty will try to reach an agreement on a single country of residence. Competent authority for the United States resides within the Internal Revenue Service. We have a whole portion of the IRS that is titled competent authority. And so that would be the competent authority for this country. The other country likely has something similar. And so that's who a person would turn to if they could not figure it out based on these tiebreaker rules in the treaty. And then the competent authorities will discuss it and reach an agreement on a single country of residence. And please remember, every treaty is different. What I listed here is generally the way they're going to look, but you would want to look at that particular treaty and be very careful in determining how it applies in a particular case. Some treaties require that U.S. citizens or green card holders have to satisfy additional requirements to be residents of the United States for purposes of the treaty. For example, a treaty might have a provision that U.S. citizens or lawful permanent residents, meaning green card holders, will not be treated as residents of the United States for treaty purposes unless they have a substantial presence, permanent home, or habitual abode in the United States, and they are not treated as residents of a third country under a treaty between the other contracting state, meaning the other country, and that third country. The tax treaty between the United States and the United Kingdom is an example of a treaty that has this additional rule. So under the United States-United Kingdom treaty, an individual will not be treated, even if they're a U.S. citizen or resident, they won't be treated as a U.S. resident for treaty purposes unless they have a substantial presence, permanent home, or habitual abode in the United States, and are not treated as residents of some other country, meaning besides the United States and the UK, under a treaty between that other country and the UK. Okay? And please be aware that the substantial presence requirement in these treaties is, you hear the word substantial presence, but this is not to be confused with that substantial presence test that was discussed earlier, meaning the one in the Internal Revenue Code and the one that we use to apply in determining whether an individual is a U.S. resident under U.S. domestic law. Okay, now let's talk about the actual taxation of dual resident taxpayers. And there was a question in the chat feature, I saw that earlier, about this very topic. So whoever asked that about the green card holder and whether they could choose to just not have to be treated as a resident of the other country under the treaty, I hope whoever asked that has their ears pricked up right now, because that's what I'm heading into here. So for any tax year or portion thereof for which a person determines, an individual determines that they're a resident of a foreign country for treaty purposes under the tiebreaker rules that we just talked about in the treaty between that country and the United States, then they may choose to either be treated as a resident of the other country and file as a non-resident on Form 1040-NR, attaching Form 8833, Treaty-Based Return Position Disclosure, or this person, who's typically going to be a green card holder, can choose to not be treated as a non-resident and instead file as a U.S. resident on the Form 1040. Again, this is only provided that after you look at all those tiebreaker rules, you know that you shook out as a resident of the other country that was party to the treaty. Okay? So that answers that question. A green card holder would then have that choice to be treated as a resident of the other country, as listed here on the slide, or they can just disregard that and be treated as a U.S. individual. So choose to not be treated as a non-resident and just file as a U.S. resident on a Form 1040. Now I'm going to turn the mic over to Emma to cover just a few more topics. Emma?
Thank you, Bethany. Individuals often prefer to be treated as non-residents for U.S. tax purposes in order to avoid the broad reach worldwide taxation. Sometimes, however, a non-resident elects to be treated as a U.S. resident taxpayer. For example, a non-resident with limited income who's married to a U.S. citizen may choose to be treated as a U.S. resident for purposes of claiming refundable tax credit. This slide compares and contrasts the joint return elections under Sections 6013G and 6013H. Section 6013G allows a non-resident who's married to a U.S. citizen or resident the ability to, along with their spouse, file a joint U.S. income tax return, choosing to be treated as a U.S. resident for income tax purposes for the entire tax year. If an election is made under Section 6013G, then the worldwide income of both spouses is, in general, subject to U.S. income taxation for the entire year of the election. Note that this election is different from the first-year election under Section 7701B4 that I discussed earlier, because the worldwide income of the individual making the first-year election is only subject to U.S. taxation for part of the election year, whereas individuals who make the Section 6013G election are subject to U.S. taxation for the entire year. And that election applies to all future years unless suspended or terminated, meaning that after filing jointly in the election year, the individual must continue to file as a U.S. resident as either married filing joint or married filing separately. Now let's talk about the joint return election under Section 6013H. The joint return election under Section 6013H affords a non-resident who's married to a U.S. citizen or resident and who becomes a U.S. resident by the end of the tax year the ability to be treated as a U.S. resident for income tax purposes for the entire taxable year. If the election is made, then the worldwide income of both spouses is, in general, subject to U.S. income taxation for the entire taxable year. Additionally, if both spouses begin the year as non-residents and then both become residents by the end of the year, they can make this election provided the other requirements are met. One of the major differences between this election and the joint return election under Section 6013G is that under the Section 6013H election, the non-resident spouse actually becomes a U.S. resident during the tax year. This is different than the Section 6013G election, under which the non-resident spouse is only considered a U.S. resident for purposes of most income tax and filing requirements after the election is made. Like the election under Section 6013G, this election is different from the first-year election because the worldwide income of both spouses is subject to U.S. taxation for the entire tax year. However, individuals who make the first-year election can also make the joint return election under Section 6013H to be considered U.S. residents for the entire tax year rather than just part of the tax year. This is so because the requirement that one spouse must be a U.S. citizen or resident to make this election can be satisfied by making the first-year election that we previously talked about. Anika, let's do another polling question.
Sure, Emma. So, audience, our fourth polling question is, Mary, a U.S. citizen, is married to John, a non-resident. John was not a U.S. resident at any time during 2024. Can Mary and John make an election to treat John as a U.S. resident and file a joint U.S. income tax return for 2024? If you believe the answer is yes, select A, and select B for no. So take a moment and click the radio button that best answers the question. If you do not receive the polling question, please enter only the letter A or B that corresponds with your answer in the Ask Question text box. Your response is time-stamped. I'll give you a few more seconds to make your selection or submit your answer in the Ask Question feature. Okay, so we're going to stop the polling now, and let's share the correct answer on the next slide. And the correct response is A, yes. I see that 85% of you have responded correctly. Way to go, guys. That is an amazing response rate. So, Kathy, are you ready to talk about dual status individuals and how they're taxed?
Yep, thanks, Anika. So a dual status individual is subject to different rules for the part of the year spent as a U.S. resident and the part of the year as a non-resident. All worldwide income for the period of residence and all income effectively connected with a U.S. trade or business for the period of non-residence after allowable deductions is combined and taxed at the graduated tax rates that apply to U.S. citizens and residents. U.S. source income that is not connected with a U.S. trade or business for the period of non-residence is subject to the flat 30% rate or the lower treaty rate. No deductions are allowed against this income. There are special rules that do apply to dual status individuals. So a dual status individual, they cannot claim the standard deduction and is not allowed to file as head of household and cannot file a joint return unless married to a U.S. citizen or a resident and with the spouse elect to file a joint return. And Emma went over those qualifications. A dual status individual who is a non-resident at the end of the tax year was married to a U.S. citizen or resident for all or part of the tax year and did not file jointly with their spouse generally must use the married filing separately tax rate and may not claim the earned income credit, the credit for elderly or disabled, or the education credits. So the type of U.S. income tax return filed by a dual status individual depends on whether that person is a U.S. resident or a non-resident at the end of the tax year. And we saw a question in chat about this as well, so hopefully you're listening because here I'm answering your question. So an individual whose status changes from a non-resident to a U.S. resident during the tax year and who is a U.S. resident on the last day of the tax year, they must file Form 1040 and write dual status return across the top of the return and attach a statement, which is usually Form 1040-NR, with the words dual status statement across the top, showing the income for the part of the year spent as a non-resident. A U.S. resident who gives up residence in the United States during the year and who is a non-resident on the last day of the tax year, they must file Form 1040-NR and write dual status return across the top of the return and attach a statement, which is usually Form 1040, with the words dual status statement across the top, showing the income for the part of the year spent as a U.S. resident. So we provided you with a lot of information, and to summarize, these are the types of resident status for U.S. tax purposes that we have covered in today's webinar. The U.S. citizen who is taxed on worldwide income, the U.S. resident who is either a lawful permanent resident, they met the substantial presence test, or they made a first-year election and is also taxed on worldwide income. And the non-resident who is neither a U.S. citizen nor a U.S. resident and is therefore taxed only on U.S. source income, but may choose to be treated as a U.S. resident by filing a joint return with their U.S. citizen or U.S. resident spouse under IRC 6013G or H, and would then be taxed on worldwide income. And the dual status individual who was both a U.S. resident and a non-resident during the same tax year and would be taxed on worldwide income for the portion of the year in which they were a U.S. resident and would be taxed only on U.S. source income for the portion of the year in which they were a non-resident. So listed here are some resources that you may find helpful. So Publication 519, which we mentioned in the training, a link to pages for individual taxpayers with international aspects to their returns, a link to U.S. income tax treaties, and taxpayer assistance numbers. So shown here is a link to the page where you can find various practice units that pertain to residency. Now, practice units are written by IRS staff and provide explanations of general tax concepts and information about a specific type of transaction. And that concludes our presentation. Turning it back over to you, Anika.
Thank you, Kathy. So, hello again, audience. We have come to our live Q&A. I'm going to be moderating the Q&A session, but before we start, I do want to thank everyone for attending and staying engaged during today's presentation, Determining an Individual's Tax Residency Status. Now, earlier I did mention that we want to know what questions you have for our presenters. So here is your opportunity. If you haven't input your question, there's still some time. So go ahead and click on the drop-down arrow next to the Ask Question field, type in your question, and click Send. Bethany, Emma, and Kathy are going to stay on with us to answer your questions. In addition to our wonderful presenters, we also have Lindsay Stellwagen from Small Business Self-Employed Special Counsel International, also known as the Litigation and Advisory Division. She's graciously joined us to answer some questions during our Q&A today. And just one more thing before we begin, our Q&A panel may not have time to answer all the questions submitted because you guys have definitely sent us a lot of questions, but we are going to answer as many as time allows. So let's go ahead and get started so we can get to as many questions as possible. Just going to move over here to our Q&A. All right, so I think the first question that I have here is for Bethany. How long can a student on an F1 visa who is in optional practical training or OPT remain an exempt individual, meaning exempt from counting days of presence under the substantial presence test?
Okay, well, a person who is here on an F1 visa, sometimes they are provided that opportunity for optional practical training. It usually happens after they've graduated, and what that allows them to do is to work for an off-campus employer full-time without taking any classes while still remaining in valid F1 non-immigrant status, meaning they are exempt from counting days for purposes of the substantial presence test. This only lasts for 1 year. That's the max that it can last for. And of course, during that time, they have to be actually doing that. So it usually occurs after graduation. It allows them to work full-time off campus for exactly a 1 year period. And during that 1 year period, they're still in F1 student status, even though they are not taking classes and have already graduated and are working full-time off the campus. After that year is up, their days in the United States must generally be counted for purposes of the substantial presence test. So whenever that year terminates, they begin to count days. And I also wanted to mention to you folks on the platform there that the chat feature has been saturated enough right now with questions that we plan to answer that you're probably going to have to remove one in order for us to insert any more that are listed there. So just suggesting we begin to remove some of those as they're answered. Thank you.
Okay. So, Bethany, this next question is for you as well. Can you give an example of dual status individuals?
Yes. Okay, so a dual status individual, it usually would happen in the year of arrival or departure from the United States. It's a year in which they began the year, let's say, as a non-resident, and they end the year as a resident. So, for example, there could be a situation where an individual received a green card late in the year and then traveled to the U.S. Let's say they won some green card lottery, or a person who came to the United States, let's say April 8th, I'm just picking a random date. So they arrive in the United States April 8th, and you can see that they're here more than half the year, right? So they're going to have met that 183-day test. But their residency start date is that day that they arrived, so April 8th, if that was when they first arrived here, and then they subsequently met that substantial presence test. So for the days before April 8th, they were a non-resident. For the days after that, they were a resident. And vice versa, on the other end, if a person, let's say, turns their green card back in and exits the United States at some point, and from that point onward, they are resident in another country and have stronger ties there and have a tax home there, et cetera, and so their residency may have terminated before the end of the year, then in that case, too, there may be a dual status situation in terms of residency. I hope that helps to answer it.
I think that was a pretty thorough response. Hopefully that help the audience out. Emma, I'm going to direct this next question to you because I believe you covered this during the presentation. So the question is, can an undocumented individual be considered a U.S. resident for
Yes.
U.S. income tax? Okay.
Yes, and an undocumented individual may be considered a U.S. resident for U.S. income tax purposes. As previously mentioned, residency concepts under U.S. tax law and U.S. immigration law overlap but are not synonymous.
Okay. All right. Thank you so much for that response. Um, Kathy, I am going to toss this next question your way. Where did you find a list of countries with treaties?
Okay, sure. Thanks, Anika. So there is a great page on irs.gov, and there's actually a link to it on one of the slides that I mentioned. It's entitled Treaties A to Z, and if you go to that website, all of the countries that we have a treaty with are listed there on that page, and they're listed in alphabetical order, and you can click on each country and it directs you to their treaty. So.
Okay, Kathy, thank you so much for that response. Bethany, I'm going to direct the next question to you. I believe you covered this one. So how does an individual in temporary protective status file? How do they file?
Okay, a person who's here on temporary protected status, they generally count their days of presence just like anybody else would. So how they file will be determined by whether or not they met that substantial presence test for the year in question. So after counting days, then that'll determine whether they are or are not a U.S. resident for income tax purposes.
Okay, thank you so much for that response. Bethany, I think I'm going to toss this next question your way as well. So can a U.S. citizen file as a non-resident under the tiebreaker rules of an income tax treaty?
No, they cannot. Yeah, I think there was somebody had asked that. I saw that in the chat, and no, that is the green card holder who can apply those tiebreaker rules, not a U.S. citizen. And kind of related to that, someone had been asking, we talked about the U.S.-UK treaty and how there were some extra provisions in there. Those provisions are not going to ever allow a U.S. citizen to file on anything other than a Form 1040. So what those provisions were saying is basically if I was living over in the UK, I would not be able to exempt myself from tax on certain types of income under that treaty if I'm, as a U.S. citizen, eventually if I were over there, living over there. They wouldn't give me a break on that. So that's kind of what that was alluding to. It does not allow the U.S. citizen to ever file as though they're not, so I'm trying to page back to my notes on that real quick, just to make sure it's clearer to people. So in that case, what happens is the treaty provides, this is from the UK's vantage point, that U.S. citizens will not be treated as U.S. residents unless they have a substantial presence, permanent home, or habitual abode in the United States, and the other piece, well, we don't need to worry about that, not treated as residents of yet another country. So in that case, when they're trying to tax me on some piece of income, I can't claim U.S. residency under that U.S.-UK treaty and invoke that with them unless I'm living over here in the U.S. So if I was here in the U.S. and there was some piece of UK income that I could exempt myself from, even if I was under the tiebreaker rules of the treaty, perhaps still looked at as a dual resident. So I hope that makes it clearer. I guess the big takeaway is if you're a U.S. citizen, you have to file a 1040. And you can take a position on, you can still sometimes find an exemption of tax on income under a treaty subject to the provisions of what we call the saving clause in the treaty, which preserves the U.S.'s right to tax its citizens and residents as though the treaty did not exist, okay? So you have to look at that piece too. So most treaties have a clause in them that says that we can tax our citizens and residents as though there were no treaty except for, and then we list some exceptions. And the first paragraph of exceptions applies only to people that don't have green cards and are not U.S. citizens. And then the second piece, which would usually be labeled B, subparagraph B, would have exceptions that apply to U.S. citizens. So there's very little in the treaty that can help you if you're a U.S. citizen. So when you look at a treaty, if you want to invoke benefits and tell the U.S., oh, I don't have to pay that because of, and point to a treaty, it's pretty limited when you're a U.S. citizen or a U.S. resident. But a U.S. citizen or green card holder particularly are very, very limited in what they can claim. And no, a U.S. citizen cannot take the position that they're the resident of another country under a treaty, under any treaty. They still have to file on a 1040 and report their worldwide income and back out, they still can back out something that may still be available to them as a benefit, but they have to, the start point, the default is you're going to be reporting your worldwide, sorry, I've got a dry throat, your worldwide income, and sometimes you can mitigate the effect of double taxation by obtaining a foreign tax credit, using a foreign tax credit to offset that. I hope that helps to answer this.
I think that was a great response, very detailed, and I'm sure that the audience appreciates that. So this next question I'm going to direct to Kathy. Kathy, I believe you covered this one. So if you're a non-resident, do you still have to file a tax return even if you don't believe you owe any taxes due to a tax treaty?
Yes, Anika, thank you. So the answer to this question is yes. So even if you believe that a treaty provision allows it that you don't have to pay any U.S. taxes, you still need to file a Form 1040-NR, and then you would attach Form 8833 so that's where you put the detail for your tax treaty provision that you are using to exempt all of your income from tax. And this is per IRC Code Section 6114. And you can review the instructions on Form 8833, and that'll give you more clarification on what you need to include on that form. But yes, even if you have zero tax after the tax treaty provision, you still need to file with that Form 8833. Hopefully that answers your question. Thank you.
Thank you so much, Kathy. This next question I am going to direct to Emma. I believe that you covered this one, you covered this topic during today's webinar. So here's the question. If someone has recently become a U.S. citizen, but also holds citizenship in another country, let's say, for example, Brazil, in the other country, the person receives retirement benefits and owns a property. There's no rental income. However, in the U.S., There was no earned income at all. So does this person need to file U.S. taxes even though a foreign tax return was filed reporting both the retirement income and the property?
Yes. In this example, the individual is a U.S. citizen. Therefore, this person is taxed on their worldwide income, and they must report all of their worldwide income on their U.S. income tax return, regardless of the character and source of income. Thank you, Anika.
No problem. Emma, I'm actually going to have you answer this next question for me as well. So what is the reason for an individual wanting to file a U.S. income tax return as a non-resident, like a Form 1040 NR?
So as I mentioned before, U.S. citizens and residents are generally taxed on their worldwide income, whereas non-residents are taxed only on their U.S. source income and income that is effectively connected with the conduct of a U.S. trade or business. Therefore, that individual filing a non-resident tax return in the U.S., they would pay less taxes than a U.S. tax resident because they don't have to report their worldwide income.
Emma, thank you so much for that response. Kathy, this next question is for you. Which form does a dual status person file? Is it the 1040 or the 1040 NR?
Okay, so which form they file is going to depend on what their residency status was on that last day of the year. So if they are a resident on the last day of the year, then they would file the 1040 with the 1040 NR attached as a statement. And if they are a non-resident at the end of the year, then it would be flip-flopped. So they would file Form 1040 NR with the Form 1040 attached as a statement. And this was covered in the presentation because there's a statement you have to write on the top of the form. So it does depend on what your residency status is on December 31st of that year.
Okay, awesome. Thank you so much for that response, Kathy. So Bethany, it looks like I'm going to give this next question to you. So how is a service member whose residency is Puerto Rico treated when their duty station is temporarily in the U.S.? Is Form 8840 required? Are they exempt from U.S. tax due to being sourced to Puerto Rico?
Okay. This individual, if they're a bona fide resident of Puerto Rico, and then again, I mean, how much time are they in the U.S.? I think that's going to be a part of it. Now, depending on how long they happen to be here as well. So they may or may not meet that substantial presence test. But generally, if you're a bona fide resident of Puerto Rico and you have income from sources outside Puerto Rico, and I would say that the fact that they were temporarily stationed here would indicate that they're still a bona fide resident there, most likely. So they would report their worldwide income to Puerto Rico, as they always should. And then if they have income from sources outside Puerto Rico, then they would file a U.S. Form 1040 reporting their worldwide income and excluding income from sources in Puerto Rico other than amounts received for their services as an employee of the U.S. government, meaning in the military as they're doing, or any other type of U.S. government service. And this answer is true for anyone who is a bona fide resident of a U.S. territory. So anyone who is a bona fide resident of a U.S. of Puerto Rico, I'm sorry, I'm talking about Puerto Rico here. Anyone who's a bona fide resident of Puerto Rico, regardless of whether they are a U.S. citizen, a U.S. resident, or neither,
either way, if they're a bona fide resident of Puerto Rico, which is defined in Internal Revenue Code Section 937 under those rules, then they report their worldwide income to Puerto Rico, to the Hacienda. And if they have income from sources outside Puerto Rico, they also file a U.S. 1040 and report their worldwide income to the United States, excluding income from sources in Puerto Rico, other than what they might have received from the U.S. government as an employee of the U.S. government. And I hope that sheds some light on that. I think
yes,
that there's.
Oh, I'm sorry.
Oh, I'm sorry. I think there are other questions too that we can answer, and I think we're starting to get a little backed up. But
yeah,
so many questions.
I know. It's
a lot to look at. But anyway, I think there's a few more there that are waiting to be answered. So thank you.
Yeah, it definitely a lot of questions here to choose from. And we just want to pick the best ones that'll best serve the audience. So, Kathy, I think I'm going to direct this next question towards you. Please explain that exempt in this case does not mean that they don't have to count days towards residency. I hope I'm reading this right. Okay, I'm gonna skip over that one. So Emma, I'm going to direct this question to you. What does cutting up the green card mean?
Yes, so I had mentioned that previously, and the point was, even if your green card is destroyed, lost, or if you let it expire, you're still a lawful permanent resident, and you have to turn in your green card and renounce your U.S. immigrant status by signing USCIS Form I-407. So that was the point of saying cutting up the green card. Still means that you are a lawful permanent resident. I hope that explains the question.
Yes, that explained the question there. So let me go back to the Q&A and see what. Okay, all right. I think I have a good one here. So for Bethany, I'm gonna direct this one to you. Don't residents of Puerto Rico file their own special returns? Also, they are U.S. citizens.
Okay. As we said earlier, if someone's born in Puerto Rico or the other territories, they're a U.S. citizen. If they're born in American Samoa, they're a U.S. national. I also saw someone asking what is a national. A national is someone who owes allegiance to the United States and basically is quite similar to a citizen, at least when it comes to taxation. They are taxed in the same way. So that was that was a little aside about the word national. But people who are born in Puerto Rico are U.S. citizens, but not every bona fide resident of Puerto Rico was necessarily born there. Some are people that were born in the U.S. and went over there. They, too, would, of course, be U.S. citizens. But there are people that may relocate there from other parts of the world and, therefore, not be U.S. citizens. So not everyone who's a bona fide resident of Puerto Rico would necessarily be a U.S. citizen. And it's true that residents of Puerto Rico file their own Hacienda return with their taxing authority, which is the Hacienda. Having said that, as I mentioned, if they have income from sources outside the territory, outside Puerto Rico, then they are required to also file a Form 1040 with the United States. And on there, they also report worldwide income. So they report worldwide income to Puerto Rico, to the Hacienda, and they have a second filing requirement if they have income from sources outside Puerto Rico. In that case, they have to file a U.S. Form 1040 reporting their worldwide income and they can exclude income from sources in Puerto Rico other than amounts that they received from the U.S. government for the work that they did as an employee of the U.S. government. I hope that makes it a little bit clearer.
Yeah, absolutely. That was a great explanation. But I wanted to circle back in regard to counting exempt days. Can you clarify what it means in regard to counting exempt days?
Yeah.
Oh, I'm sorry. I thought that was me, and I was like, what?
Oh. Yeah, I'll take that one, Bethany. So when looking at days that an individual is an exempt individual, we want to clarify that if they're an exempt individual based on their visa type or the different categories that we mentioned, then they can't choose that they can count those days. If they're an exempt individual, they cannot count those days towards the substantial presence test. They're an exempt individual, so those days do not count. They can't choose yes or no. It's black and white. If they're an exempt individual, those days do not count. So hopefully that answered your question.
Yes, Kathy, thank you so much for that explanation. Let me see. Do we have any other really good topic-related questions that we want to address with the audience?
This is Lindsay. Maybe I could jump in for a second just to follow up a little bit on that last point. Most of what I do is advise exam and litigation. And my advice is always our threshold question when we start in audit or even in a piece of litigation is, do we have jurisdiction to tax? Because if the answer is no, then we're not moving forward. And so in the question of a U.S. citizen or green card holder, LPR, yes, we do have jurisdiction to tax. Where it becomes more problematic is that if it appears to be a non-resident, and did that individual, have they tripped something like the substantial presence test? And that's where we do the deep dive into the exempt, the days, and watch the visas and the treaties and special circumstances to just find out, A, are we going to go forward with this? And of course, what's at stake is a worldwide tax. And to many individuals, particularly those of high wealth, this is critical, because they could get double tax relief through a treaty, but if there's no treaty, they could be looking at double tax. And so I don't know, some of the audience may have seen that recently there was a criminal sentencing with a prison term, a substantial prison term, of an attorney who was convicted of aiding and abetting false and fraudulent returns of people who had just done that. They were high wealth individuals who had tripped the substantial presence test or become residents or becoming residents and faced tax on their worldwide income, which was significant. And this individual who was convicted was then trying to hide that income. So it's the worldwide income that is often at the crux of our litigation and audit work in this area. And that's why the presentation that Bethany and Kathy and Emma have given today, it's detailed, it's cumbersome, but it's so important. So thank you for letting me jump in there.
Lindsay, we appreciate you for providing that additional insight. Bethany, I'm going to direct this towards you. We've seen a lot of questions that are referring to accidental Americans. Do you want to elaborate a little bit more on that for us?
Yes, thank you. Yeah, there's a number of questions in here from people who are saying, what about a person who, left the United States when they were like a 6-year-old? They were very little. And then, they were born in the U.S. and their family moved back over to wherever they came from. and they are still over there, and now they're an adult, and they're wondering, do these people have to file Forms 1040? And the answer to that is yes, they do. They do. And so sometimes those people refer to themselves as accidental Americans, meaning, you know, they didn't intend to be born here. They just happened to be. And they've been gone. Some people leave when they're, you know, less than a year old, so they don't even remember this place. But the unfortunate fact for them is, yes, they do owe us a Form 1040 reporting worldwide income. And again, there are mechanisms to perhaps mitigate some of the possible double taxation. And obviously, the other option is a person could expatriate, meaning formally surrender their U.S. citizenship if they didn't want to be bothered with the filing of the 1040 each year. So I just wanted to speak to that because I saw quite a few questions on that. So
Yeah.
thank you for
And
asking.
Bethany, again, this is Lindsay, to jump in briefly.
Sure.
What you can't, Bethany is absolutely correct on her analysis. Where it sometimes becomes relevant is on the penalty situation and a reasonable cause defense. That they didn't file because they didn't know. But that's a penalty. That doesn't go to the tax.
Well, Bethany and Lindsay, thank you both for elaborating on accidental Americans for us. But it looks like that is all of the time that we have for questions. So I do want to thank the Q&A panel for answering your questions and sharing their knowledge and expertise. But audience, we can't leave without our final polling question. So our last polling question is an attendance check. So please select the radio button on the screen. If you do not receive the polling question, add only the letter A as your response in the Ask Question text box to timestamp your response. Audience, please remember that you need to answer at least 4 polling questions and participate in a live broadcast from the official start time for at least 100 minutes to earn 2 IRS continuing education credits. The polling question example we did at the beginning of the presentation will count towards this requirement. I'm going to give you guys a few more seconds to select the radio button or submit in the Ask Question feature. All right, so we're going to go ahead and stop the polling now. Thank you for responding and participating in the polling questions. You guys really did a knockout job today with the polling questions. But before we close out today's session, Emma, can you share some key points that you want the attendees to remember from today's webinar?
Absolutely, Anika. Here are some items to remember. Your residency status for U.S. tax purposes is very important and affects how you're taxed. It determines your filing status, the amount of your income that is subject to U.S. income tax, which deductions, credits, and exemptions you may claim, and the applicable tax rates. The United States generally taxes its citizens and residents on worldwide income. They may also be subject to employment taxes. Residency concepts under U.S. tax law and U.S. immigration law are not synonymous. A non-immigrant or an undocumented individual under U.S. immigration law could, depending on the circumstances, be a U.S. resident, a non-resident, or a dual status individual under U.S. tax law. A U.S. resident is an individual who is a lawful permanent resident of the United States, meets the substantial presence test, or makes a first-year election under Section 7701B4. Cutting up the green card or destroying the green card or remaining outside the United States for an extended period does not change an individual's status from U.S. resident to non-resident for tax purposes. Anika, that wraps up our key points.
Thank you, Emma, for those key points. So, audience, we are planning webinars throughout the rest of the year. To register for upcoming webinars, please visit irs.gov Perform a keyword search for webinars and select the webinars for tax practitioners or webinars for small businesses. When appropriate, we will offer certificates and continuing education credits for upcoming webinars. We do invite you to visit the IRS YouTube page at www.youtube.com/IRSvideos. There you can view available recorded versions of our webinars and other key video messaging once posted. Again, continuing education credits or certificates of completion are not offered if you viewed an archived version of any of our webinars. I want to give another big thank you to our presenters, Emma, Kathy, and Bethany, for a great webinar, and also a big thank you to Lindsay for helping out with Q&A. And I also want to thank you, the attendees, for attending today's webinar, Determining an Individual's Tax Residency Status. Now, if you remember, if you attended today's webinar for at least 100 minutes after the official start time, and you answered at least 4 polling questions during the live broadcast, you will receive a certificate of completion for 2 IRS continuing education credits, or if you attended for at least 50 minutes after the official start time and answered at least 3 polling questions during the live broadcast, you will receive a certificate of completion for 1 IRS continuing education credit. Remember, the polling question example will count towards the minimum question response requirement. Audience, it is important for you to know that certificates of completion will be emailed to the registration email of the qualifying participants as a PDF attachment. The email will come from the email address seen on this slide, cl.sl.web.conference.team@irs.gov. Please add this email address to your contacts to ensure that you receive the email with the certificate attached. If you're qualified for IRS Continuing Education Credit for this webinar and you registered with your valid first name, last name, and PTIN as it appears in your IRS PTIN account, your Continuing Education Credit will be posted in your IRS PTIN account. If you're eligible for continuing education from the California Tax Education Council, your credit will be posted to your California Tax Education Council account as well. If you qualify and have not received your certificate and or credits by September the 8th, please email us at the email address shown on this slide. That is cl.sl.web.conference.team@irs.gov. And if you're interested in finding out who your local stakeholder liaison is, visit irs.gov or send an email to the address shown on this slide and we'll send you that information. Now, we would appreciate it if you would take a few minutes to complete a short evaluation before you exit. If you'd like to have more sessions like this one, let us know. If you have thoughts on how we can make them better, please let us know that as well. If you have any requests for future webinar topics or pertinent information you'd like to see in an IRS fact sheet, text tip, or FAQ on irs.gov, then please include your suggestions in the comment section of the survey. Click the survey button on the right side of your screen to begin. If it doesn't come up, check to make sure you've disabled your pop-up blocker. Now, audience, it has been a pleasure to be here with you, and on behalf of the Internal Revenue Service and our presenters, we'd like to thank you for attending today's webinar. It's important for the IRS to stay connected with the tax professional community, individual taxpayers, industry associations, along with federal, state, and local government organizations. You make our job a lot easier by sharing the information that allows for proper tax reporting. Thanks again for your time and attendance, and we hope that you found today's information helpful. You may now exit the webinar at this time.